Welcome to our High Rock monthly video for December. I'm Scott Tomlinson, and with me today on the call is portfolio manager Paul Tepsich, and also he is the founder of High Rock, founded in 2010. Wow, Paul, we've been around for a few years now, huh?
Time flies. Yeah, we have.
When we're having fun. Excellent. November was, in fact, a fun month. Let's talk a little bit about how that all worked out. All financial markets were higher, led, in fact, by Canadian preferred shares. Paul, I'll let you talk about the high yield or the preferred share mandate in a moment, but U.S. equity, global equity were all higher. Even Canadian real estate investment trusts were up, and that dragged our balanced portfolios higher as well. So while the majority of our clients have balanced mandates, I think it was a pretty good month, all told. Paul, any comments?
Yeah, I think one real comment on this chart is kind of interesting is that gold, and mind you, CEF is a fund, which has, I believe, roughly 70% gold, 30% silver, but gold hit an all-time high in November, and yet look at that. That's how well all these other asset classes did over the month of November, is that gold and silver were actually still near the bottom, up a respectable 4.5%, mind you. But these other asset classes just did spectacularly, and we can maybe talk about why REITs and prefs in particular were up as much as they were when we go through the deck.
Yeah, absolutely, absolutely. So again, this is 1 month in what has been a long journey. Let's just put this in a bit of perspective and look back over the last couple of years. And really, we see that even U.S. equities aren't even at the highs that they got to in the late 2021. About flat to where they were in November 2021. So it has been a long journey. Obviously, 2022 was one of the worst years for financial markets in a long time. So the recovery has been okay, but even balanced portfolios are still not back to where they were. And let's just look at our balanced benchmark that we use, the iShares Balanced Core ETF, 2-year annual average total return just under -1%, so -0.75% over 2 years. So basically, balanced portfolios are still in negative territory over a 2-year period. That's quite something, actually, that we haven't seen in some time, and I think it's certainly or to a large degree represents a lot of the uncertainty that is in not only in the economic environment, but also certainly in the political environment as well.
And Scott, if I can just comment on that slide, when you say the XBAL is something we use, we don't invest in this ETF. We simply look at it for comparison purposes to our internal balance mandate portfolios, just to be clear.
Yeah, absolutely. And it's something that our clients, if they wish, can look at to compare their performance on a relative basis to this, which is the balanced iShares ETF. Okay, so Paul, let's talk a little bit about our mandates. Let's talk, I think, first about the high yield mandate, because I know that while the majority of our clients aren't exposed to the high yield mandate fully, they do have some high yield or some of the assets that are in the high yield mandate in their portfolios, which has definitely helped their performance over the last few years, but certainly helps add significant value. But talk a little bit about how the high yield mandate has performed over the last few years.
Yeah, it's we don't give away performance, unfortunately, due to the regulatory environment. But I can say if anyone wants to know how the high yield portfolio has done over the last 3 years, that they should contact us. But it's outperformed any of its benchmarks by a pretty substantial amount. And again, not to be misleading with performance, but it's done very well. And as you said, Scott, in our private client and balance mandates, we have all benefited from owning some of the bonds that are in our pure high yield mandate. So it's been a really good run, knock on wood, especially quite frankly over the month of November, as bonds in general improved. But the other thing we've had is a very large weight in energy bonds, which have over the last number of years, more than 3 years, which have performed extremely well. And that's been sort of the secret to the success of that mandate in particular.
Well, congratulations to you for having some pretty decent foresight in seeing the value in the energy bonds that you saw 3.5 years ago or thereabouts, right?
No, better lucky than smart.
um, do you want to talk at all about the preferred share mandate at this juncture?
Very briefly, it's in its initial stages, something we started looking at. And, if we looked back, or clients look back on the previous charts over the last 2 years, I mean, preferred shares were getting absolutely annihilated in August, and through especially in September. But something I've been tracking since late 2016 when we did our first preferred share mandate opportunity. And we had one client that came in back then. I think he was up, large double digits within about 4 or 5 months, and that kind of continued for a while. It was a fantastic opportunity. When we started noticing this in August and then through September, we went out to some folks that we thought it was important to get to and show that this disconnect was happening again. So good news, bad news. By the time we got some clients involved and they had already bottomed and started moving up, we were able to capture some of that upside. But we are about 50% invested and looking for a little bit of a pullback here before deploying more of that capital. So we're still quite positive on this trade, but we will be somewhat judicious at putting that capital to work. That's it.
Excellent, excellent, thanks. And just a reminder to everybody that what we do here at High Rock is all about focusing on your goals as clients and determining what the best asset allocation strategy is for you for the long term. So if any of the conversations that we're having here today, if you wish to understand more about any of these other mandates, other than the balance mandate, or even dig deeper into the balance mandate, we are always standing by to have these conversations. If, as we do, look at your goals to make sure that they're on track, if we can, and if there is room for adjustment, then we definitely want to have those conversations. So again, we're heading into the end of the year. We will certainly in the new year be back to talk to you about things like RSPs and TFSAs and certainly the strategies that your portfolios should be taking as we go forward. But these are things that if you have any questions or any concerns that you want to bring to us, it doesn't have to be at any given time. You can just get on the phone or send us an email, and we're there to continue to have these dialogues. So just wanted to bring that forward as we head into the year end. Okay, let's quickly talk about our global equity strategy. As most of you do know, we look to buy equities when there's value, and as we rebalance, we look to take profits when stocks get overvalued. So at this particular junction in time, stocks are more overvalued than undervalued, and so as we do rebalance, as we need cash flows, we're looking for opportunities to take profits in our equity holdings, if of course that's what your asset allocation strategy is pointing towards. So at this juncture, we don't have buying hats on. We have more likely to have selling hats on. But again, we monitor this closely and watch to see when the benefits for your portfolios arise. Tactical strategy, Paul.
Yeah, the only one addition we put through in the tactical model over the month of November, and it's one we had previously. We had a pretty good trade in it, is Auto Canada stock. So there's the only publicly traded group of auto dealerships in the country. So we did have a good trade in it earlier this year. We added a small weight, and the reason why it's so small is it's so bloody illiquid, this stock, and volatile because of that illiquidity. And we could add more here, I suppose, but boy, it's a tough one. However, as interest rates, so we own it around where it's trading now. Maybe it's trading slightly higher than our adjusted cost base, but basically there. And we'll talk about this, I'm sure, in a second. I don't want to belabor it, but as interest rates have crashed down here over the past month, or 2 months, to be honest, this should start actually helping the consumer and improving some of these discretionary goods like autos. We could start seeing a host of mortgage rate declines, auto loans, leases, etc. So I'm again, I'm not in love with this company or stock, but it is a pretty good trader. So that's the only change in the tactical model. And then in the fixed income, we did had some risk for some newer clients at times, more of it in the on the rate side or government bonds. The other thing we did add in late November was another preferred share. You'll see it in your portfolio. It's a TD Bank .B as in Bob, and that comes up for reset. Every 5 years they reset. This one comes up in July 2024. The reason why we bought that is because and we also own it in the preferred share mandate, but we added it to our balance mandates as well, is that TD Bank is long or has massive, about 14.5 billion of excess Tier 1 capital, which is the regulatory capital they need to have on their balance sheet, because they didn't make a U.S. bank acquisition. So they're long all this excess Tier 1 capital, which means they could, and they did in September, buy back a preferred share. Preferred shares are considered Tier 1 capital for the banks. So we kind of think they're going to buy that back at par, which is $25, and it's trading. When we bought it, we bought some at I believe roughly 18.5, and it's currently trading at 19.5 area. So that's a pretty healthy return over a 6-7 month period, along with a little bit of dividend income coming into us. And other than that, which maybe, Scott, you want to talk about what the Bank of Canada did this morning, December 6th at 10 o'clock, and how it affected interest rates. But I just mentioned before, but 5-year Government of Canada bonds are now down almost 110 basis points over a 2-month period. So they are way ahead of what any central bank is going to do. But I would just add that between the U.S. Federal Reserve, the European Central Bank, and the Bank of Canada, and I think much the same in New Zealand and Australia, the government bond yields are way ahead of these central banks in believing that the rate hike cycle is done. The next policy move will be rate cuts, and the market is way ahead of the central banks in believing that is going to happen. So we have to stick handle around that, which most people will be able to look at their portfolios and see that the government bonds that we own have had a pretty substantial move higher in price, which has been great. So what do you think about the Bank of Canada and what they reported today?
Well, they held rates at 5%, which was widely expected. I think the most important thing that the message they're sending is that they're still concerned about inflation. I think it's a good message to be sending. I think they're focused a little bit on recent hikes in wages and salaries, and that they're trending a little bit up higher than their inflation target. So I think that's the message that Bank of Canada wants to send. But it's clear from economic data that the Canadian economy, and certainly we're seeing it in the US as well, the economies are starting to slow. Employment rates should start to fall, or unemployment rates should start to rise. And I think that's being built into, as you said earlier, the bond markets, right? So we are seeing longer term yields falling, which is helping bond prices rise. And based on that, I think we can start talking about Bank of Canada rate cuts coming in the new year, perhaps as soon as March, right?
Yeah, and one macroeconomic research group that we get some access to is looking for a 200 basis point or a 2% cut in the overnight rate between now and the summer. And my gut tells me that certainly, in our circles and household ourselves, like, if the overnight rate or prime goes from 720 to 520, I don't think consumers are going to rush out and be buying and levering up and buying cars. And it may help the real estate market a little bit because that's a pretty decent sized move. But I don't think, I think people have been shocked by the speed and the height that the policy rate has gone up, and therefore all these consumer rates, whether it's mortgages or leases and loans, etc. I think people have stared over the abyss, and they're more going to want to continue to pay down debt as opposed to lever up your household again. So that's kind of my view. I do think we're going to see pretty substantial rate cuts by the bank, the Fed, the ECB over the next 6, 7 months.
Well, that's good news for people with floating rate debt, with for people with variable mortgages, things like that. So I think they can look forward to something a little bit better for them in 2024.
Yeah, Merry Christmas.
And on that note, thank you all for tuning in. But on behalf of Paul and Diane, we want to take this moment to wish you all the very best of the holiday season, and hope that you and your families have a wonderful time. And we will look forward to coming back and welcoming in the new year with our next High Rock monthly video. And until then, best of the holidays, and be safe.